A mid-market contractor manages a solid 12% net margin and maintains a pristine work-in-progress report. Yet when they walk into their legacy bank for a standard credit line, they are met with a hard denial. Before we examine why that happens, you can use the pre-frame calculator linked in the description to check your true bond capacity and the actual cost of waiting for capital. This data reveals a difficult reality for construction firms. Large banks are currently approving only 13.6% of small and mid-sized business loan applications, leaving the vast majority without access to traditional capital. Why are established elite contractors suddenly facing the same credit hurdles as high-risk startups? These rejections rarely reflect a contractor's financial performance. Instead, they are the result of structural barriers built into the banking system's own regulatory framework. To find the source of these denials, we have to look toward the federal regulations that dictate how much risk a bank can carry at any given time. The primary constraint is Federal Rule 12 CFR Part 32, a statute that sets strict lending limits for national banks to ensure portfolio diversification. This rule creates a legal cap on unsecured credit, preventing a bank from lending more than 15% of its total capital in surplus to any single borrower. Banks face even tighter scrutiny if their total construction and development loans exceed specific percentages. When these sector limits are reached, the bank is forced to freeze lending to every contractor in their system, regardless of their individual strength. In this environment, a hard denial is simply a sign that the bank has run out of regulatory room. No amount of financial health can overcome an arbitrary federal concentration limit. Moving past these bank limits is essential because capital serves as the primary engine for increasing surety bonding capacity. Surety underwriters evaluate risk through a specific metric known as adjusted working capital. To find this number, underwriters strip away soft or illiquid assets. They write down accounts receivable over 90 days to zero and apply heavy discounts to physical inventory. The math of suretyship relies on this final number. Underwriters apply a multiplier, typically ranging from 10x to 20x, to your adjusted working capital to determine your aggregate project ceiling. Because a firm's growth is tied to its immediate loss-paying power, engineering liquidity is a core requirement for scaling operations. Sophisticated operators expand their bonding capacity by securing external, unutilized bank lines of credit, specifically to bolster their liquidity profile. The SBA Surety Bond Guarantee allows 100% of an unused credit line to be added to working capital. Furthermore, upgrading to CPA-audited statements provides maximum assurance, pushing a surety to increase the multiplier tier up to 25x. If you're finding this breakdown of financial leverage useful, please like the video and subscribe to the channel for more in-depth industry analysis. Securing a credit facility is a mathematical move. It is designed to elevate a firm's bidding ceiling by maximizing the multipliers that sureties apply to the balance sheet. This creates a recurring problem. Contractors need these credit lines to scale, but megabanks are often blocked by the very concentration limits we established earlier. The solution is to move away from single institution applications and utilize a multi-lender digital marketplace. By submitting a single file to a network of over 75 lenders, a contractor can reach state-chartered banks, credit unions, and alternative specialists simultaneously. This approach identifies institutions whose specific construction concentration buckets are currently empty and ready to take on new project risk. Using a marketplace bypasses the structural bottlenecks of the megabanks, matching your credit needs with lenders who actually have the regulatory room to fund them. The cost of ignoring this leverage is high. Without it, firms frequently lose high-margin contracts to competitors who have simply secured a more flexible financial structure. You can execute this marketplace strategy by visiting BusinessLoan.Directory. This platform connects you to specialized lenders who are not currently capped by industry concentration limits. Visit BusinessLoan.Directory now to run your numbers and secure the capital necessary to expand your bonding limits. Operational excellence secures the opportunity. Sophisticated financial leverage secures the project.